Welcome back, everybody. This is part two of our intro to market efficiency. And we're moving away from the whiteboard. And now we're going to show you a couple of slides here. But first, let's start unpacking some of the questions we had that we left off with on the first video. And the question was, in behavioral finance, we believe that prices equal value in general, yes. And they're not a crazy off the wall pricing. They usually match like classical finance believes. But we have some questions. And some of those questions actually involve how can some investors earn excess returns? Now, when we think about excess returns, it's not just about outperforming the market. It's outperforming the market after factoring risk. So if we think about the capital asset pricing model, I could build a portfolio that had a beta of 1.8. And over time, that is going to outperform the market, but it's just because I took on more risk. What we're questioning is some of the findings that we had of actual excess returns after we factor in risk and transaction costs. So sometimes in order to execute the strategy or the trades that we're trying to make, facilitate those, sometimes there are costs involved. Now, these costs have gone down over the last few years. And if we're trading stocks today, we're virtually having no commissions, but that hasn't always been the case. And so sometimes that could get in the way of a profitable trading strategy. But what we found was even after that, risks and transaction costs, you still had excess returns. So we need to explain how some individuals can earn these excess returns. And then we need to explain how some trading strategies earn excess returns or have earned excess returns historically over time. So we're going to unpack 10 different types of characteristics or trades that have outperformed the market. And some of these have persisted and some of them have not. But nevertheless, they raise questions on the validity, if you will, of classical finance and the assumptions that everyone follows on the straight line because value equals price all the time. Therefore, there's no way to earn excess returns. So that's where we go, hey, let's have a conversation around this and question some of what you're doing. And the battle you're going to see rages on as behavioralists have gone back and forth, but now behavioral finance is starting to gain more credibility, more traction over time as the evidence kind of mounts in favor of behavioral from time to time. All right, so we've got, in addition to the questions, we have 3 assumptions that we make in classical finance that we want to question here. Okay? So number 1, security prices should respond quickly and accurately to new information. Security prices should respond quickly and accurately to new information. Now, that means if there is a strong earnings announcement, that the information is going to make an adjustment and then it stays. So there's no wavering on this. It's just going to move and stay. And if there's a negative earnings announcement, the same way. Everyone digests the information as it comes out and is publicly available, and then it settles into a new price. Again, no, shouldn't be a ton of wavering back and forth on this pricing. The recalibration goes either up or down, and it stays. That's one assumption that the classical finance makes. Number 2, everybody agrees on how to interpret the news. And so we all should, and this is where you're seeing, we're starting to go, wait a minute, that doesn't make sense. And that's right, because how we could have the same amount of news or give the same news to somebody, and it can be interpreted totally different. And that's why you see earnings come out on CNBC and they're talking about it, and earnings beat analyst estimates, and the stock is down 10%. So there was some guidance on maybe there was something after the call that influenced it down, that they were adjusting down. But whatever information comes out, everyone agrees that this is really good to this degree, or this is really bad to this degree. And there's no disagreement on that. So that's number 2. Everyone agrees on how to interpret news. And then number 3, if you were to try to beat the market, all of these simulated trading strategies should fail over time. Hey, you could get lucky. Anybody can do this. You could try a trading strategy and maybe for a certain amount of time just happens to be profitable for you. But over time, there's no real need to do this. So all of these trading strategies will fail over time. So those 3 assumptions that we have, these are 3 assumptions for efficient markets. And that starts our conversation on how we define different types of efficiency. But before we do that, I want to show you real quick here, share a screen here, and I want to bring over to a couple of charts that we're talking about market efficiency here. And here we go. We have Tweeter Home Entertainment Group, TWTRQ. And this was now quite a few years ago. And it was up first thing in the morning to the tune of 653.85%. And it's trading currently at almost 5 cents, opened the day at 1 cent. So we basically have a penny stock and moved up to almost 5 cents in the first day. So what happened here? And we're talking about efficient markets. So if we use the assumptions that, sure, maybe this company had a major announcement that first thing in the morning. And so we just raised the price and that was it. Good day for anybody who held this. But what we ended up finding out here is on this morning, this was the same morning that Twitter released their S1. This was back when they were announcing their IPO, their plans to become a publicly traded company. And so we now know this as X, but this was when Twitter was coming out to become publicly traded. And as soon as that was released, people jumped on Tweeter Homes, a couple $1 million company, TWTRQ, because they presumably thought it was Twitter. And so you go, okay, market efficiency. Yeah, there are some people that made a mistake. That's fine. But then it should resolve. There was no new news on this particular company. So what do you think happened to the stock for the rest of the day? I'll show you the next chart. And you can see here that it actually rose to 12 cents. So remember, it started at 1 penny, rose 12-fold over the first about 40 some minutes of the trading day. And then we all know how to interpret news. It'll shift right away and should settle if these are completely efficient markets. Well, explain then why it just hovered in midair, as there was some confusion here from about 10:10 until 10:40. And then I think everyone got what was happening here, because you can see now a downtrend. And then everyone realized that they actually hadn't purchased this new IPO. They were purchasing a Tweeter home entertainment company. And what's interesting, I find as well, is on the back end. Remember, nothing happened to this underlying company, yet it's still traded 2 hours later at 400% its initial opening. So it didn't go back down to 1 and then everything resolved itself. It actually stayed at an elevated level. We see that happen. If you remember, there was a flash crash. So here is Accenture. And if you see over here, this is a $71.9 billion company. And during the flash crash day, this was now in 2012. I remember the day. And this actually it was trading at, where was that? It says 40. And it was trading at 40, a little after 40, and it went down to about 1 cent or 10 cents here during that flash crash. So once again, no new information came in. They suddenly weren't completely broken and became completely viable again. It was the market completely froze up, and it makes me want to go in and put in some 10-cent limit orders on Accenture or other companies. So the next time there's a flash crash, somebody's at the bottom of filling those orders when it becomes 10 cents. So if you have any extra time and money, you can set up those trades for 60 or 90 days, good till canceled. And then the next time there's a flash crash, scoop up those stocks for 10 cents. Usually don't give stock advice, but that's low hanging fruit for anybody willing to commit to that. But again, it's showing you that there can be inefficiencies, but for the most part, they're efficient. So it's not a total disagreement. Again, this is a major question that we have. And it's not just about Accenture. There was many stocks on that day. And even there's ETFs. This was a different day. This was in August of 2015. And you can see here it's trading at just a random ETF, trading in the 70s range. And there was no significant news on it. It just completely froze up. There was no market for it. And it went down and traded at 43.90 before just a couple minutes later shooting back up, and it still settled at a lower price. So again, we have some questions around this. On the next video, we're going to talk about the different types of market efficiency. So when we're saying, hey, our market's efficient or not, we need to ask the next question, what type of market efficiency are we challenging? And we'll list those out and we'll continue our conversation then. So thank you very much for watching. And let me know if you have any questions. Otherwise, see you on the next video.